Hey everybody, happy Thursday, July 9th. It's a little bit before 8 a.m. in the morning on the West Coast, and it's time for another market update. A little bit early this week. I have to do some traveling today, and last week it was the 4th of July holiday, so I didn't do a video, so I wanted to make sure I got this out before I got on the road. So going into the week, it's like, well, what am I going to talk about? But thankfully or unthankfully, the U.S. and Iran have made it easy for me by starting the war again. It seems like there was more strikes yesterday. Oil prices obviously jumped on that news. This morning, it looks like there's some talk of possibly stopping hostilities, but we've like I say here we go again. We've been through this before. We know that the markets will pop if it talks about peace, and then they'll drop when we see more strikes. And it seems like they can't make up their mind. And I know the stock market had a really bad day yesterday with this news as well. So not good there. We'll get into how that affected rates here in a second, but that's still the elephant in the room. That's still the main driver in everything right now, which makes what I'm about to talk about not as important as it is in the past, but still important. And that was the June BLS jobs report. And that came in weaker than expected. At least the way we look at it. Again, like we've talked about, I don't want to see people losing their jobs, but at the same time, the stronger this report looks, the less likely it is the Fed would cut rates, because the Fed cuts rates when they want to stimulate the economy. And if they can look at these reports and say, hey, the economy's booming, they won't cut rates. So this was expected to be about maybe 115,000 jobs created, and it only came in at 57,000 jobs. They made some more negative revisions to April and May, like we've talked about. They've done that quite a bit over the last few years. So that was 74,000 in negative revisions. The one thing on here that looks positive or negative for us, I guess, is that the unemployment rate dropped to 4.2% from 4.3. But when unemployment drops because there's a bunch of strong hiring numbers, then that's a good thing for the economy. However, in this situation, it's basically the number of actual jobs fell, but the number of people in the labor force fell even more. So that dropped the unemployment rate. So that is not a good sign for the economy. That's people aging out of unemployment, no longer filing, didn't look for a job that week because they couldn't find anything, those sort of things. So not a very strong jobs report. But again, in the past, that would be a positive for us, and mortgage rates would probably benefit. But with everything going on with Iran, that's less likely to happen. Next thing, what did we get? We got home appreciation for the month of April. Remember, this kind of lags behind, and this was actually pretty resilient. But again, it's April. So month over month was down. Seasonally adjusted was down negative 0.1%. Non-seasonally adjusted, it was actually up plus 0.8%. So in this time of year, they tend to expect more appreciation. So that's why the seasonally adjusted number is negative. Still up plus 0.8% year over year at this point. Not the strongest gain, but obviously with everything going on and rates as high as they are, and the market being as slow as it has been, that obviously has a big effect on these numbers. But still resilient given everything that's happening. Hasn't turned negative year over year yet, and so forth. So good for current homeowners. June existing home sales. So this just came out right before I started making the video, and it was down quite a bit. It missed its number by quite a bit month over month, down negative 2.4% month over month. Medium home price actually was up, but again, that just depends on the type of homes that are selling. And I definitely know here, anecdotally, locally here in the Bend, Oregon area, that more higher priced homes are selling quicker, where the lower priced homes are kind of sitting now. So that's obviously it would have something to do, at least if not all to do with where rates are, where they're at. Rates are obviously going to have a bigger effect on people on the margins, people trying to get enough money to afford that mortgage, where people buying $1 million plus homes tend to be well off enough where that rate isn't going to have a dire effect on them. So again, not good to see there, because again, we want to see more home sales as we go forward, but it's very understandable given what's going on in the world and what's going on specifically in mortgage rates over the last couple of years. So where does that leave us? So the average 30-year conventional is at 6.68%, which is actually hitting close to 10-month highs. Not what we want to see there. For last time I did this video about 2 weeks ago, is at 6.53. So you can see it's jumped 0.15% since then. So again, not what we want to see. Rates head in the wrong direction. Before this war with Iran started, we were just under 5 or 6. We had a 5 number in front of it, which was great progress over the last couple of years, but not good to see it where it's at now. Upcoming, we have CPI inflation report on July 14th. The Fed meets again July 29th. Right now, they're thinking they're not going to do anything, as they haven't been doing. But really, like I said, the elephant in the room, the main thing here is the war with Iran. That needs to come to an end, like we talked about, not just morally, but for market reasons. And it needs to come to an end, and have the markets feel that it's truly come to an end, not this back and forth stuff that we've been having, because that just gets everybody a little gun shy. And I know the stock market pops, but the stock market's always been a little bit more optimistic than mortgage bonds. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great weekend, everybody. Thanks a lot, guys.